When the government announced yesterday that 10 banks would get to return TARP funding, Morgan Stanley shot out a statement of its own less than 2.5 minutes later, the company announcing that it was pleased to be repaying $10 billion in TARP capital with an attractive return to taxpayers. James Gorman is the co-president of Morgan Stanley, and he joins us now here in the studio. James, there's a great deal to talk about, not just TARP, the merger that you engineered with Smith Barney and Morgan Stanley's global wealth management business strategy. But let us start with TARP, because that is mostly the newsiest stuff. There's also some more on executive comp that we'll get to in a second. What does getting out from under TARP, the Troubled Asset Relief Program, do for Morgan Stanley that changes the way your firm does business?
Well, I think, firstly, it's not great policy for the U.S. government to own large stakes of financial institutions unless there is true distress in the marketplace, which is what we had over the last 8 months. Now that we've seen some stability, some safety and soundness return to the system, strong financial institutions like Morgan Stanley should be repaying TARP and getting back to the business that we're doing, which is originating, distributing and managing capital for the capital markets.
All right. Well, it is predicated, as you said, on stability. Obviously, there was a stress test, and you were asked to raise additional capital, which you did last week. Are you confident, though, that the stability that we have seen return to financial markets is going to stay with us?
Well, I think what the Treasury and the Fed have done is stress tested all the financial institutions, anticipating a further significant decline in the economy and in the markets, and ensure that they have the capital to support their businesses in that scenario. I'm confident we've been appropriately stress tested, as have the other leading financial institutions, and I am confident that we've seen the bottom of what appeared to be a cataclysmic decline in the financial markets. Not to say the economy is totally out of the woods. Obviously it isn't.
No, clearly it's not. What do you expect on that front, though? Let us talk about the economy for a moment. There's any number of divergent opinions on this subject. Paul Krugman, just the other day, making news by saying that the recession, as far as he's concerned, may be over this summer. Do you share that view?
It's a little hard to anticipate with the volatility we've had in the last 8 months to be projecting down to the month of when the recession is going to end. We've had probably the most severe shock to the financial system, the economy, in the last 50 years. It really isn't important whether it's this summer, the end of the third quarter, or the end of this year. What is important is that we saw a bottom, and it appeared to stabilize. Some of the uncertainties have come off the table, and that's what we're seeing. Whether the economy finally gets back into growth mode at the end of this year, early next year, frankly, is anybody's guess.
All right, no question stabilization is important, but other people would say that the growth rate that we do finally return to is important as well. At Morgan Stanley, how do you feel about this so-called new normal rate of growth that people are talking about, something for the U.S. economy in the order of 2% or less?
Well, we've come out of a tremendous boom cycle, obviously, and adjusting to that and then getting back to a more normalized growth rate, a lower growth rate than we've seen over the last decade or so, would be appropriate. But again, we have to see a lot of factors come into play. The rate of growth in China, how the European markets adjust to the different economic circumstance, the decline in unemployment in this country, and what impact inflation may or may not have on the markets.
Let's return, James, to the issue of TARP for a moment, because one of the issues remaining on the table, shall we say, is the warrants. Is Morgan Stanley actively seeking to buy back warrants from the U.S. government?
Well, we, like everybody else, we only got the top news, I think it was yesterday. We, like everybody else, are in discussions with Treasury about the warrants, and obviously we'd like to move forward on that, but those discussions continue.
Now, there is a debate, though, as to whether or not the firm should be able to buy them back right now. And there's one camp that says the government, taxpayers, as represented by the government, should have the opportunity to see some upside here. What do you say to that?
Well, I think we've got those discussions, as I said, are continuing with Treasury. I don't want to get ahead of those discussions. Clearly, it is in the long-term public interest for these companies to be free and independent of the government.
All right, James, sit tight, please. We're speaking with James Gorman here. He is the co-president of Morgan Stanley. Great to have him. We are rejoined now by Morgan Stanley's co-president, James Gorman. He's here with me in the studio. James, a couple of issues to deal with before we move on to another topic. We were talking about TARP. How much longer, in your opinion, will the financial industry continue to need government assistance in some form, whether it be swap arrangements with the Treasury Department, the extraordinary measures they've taken together with the Fed swaps of treasuries, and programs like the TALF, for example?
Well, I don't think you can talk about the industry. We've got 8,000 banks in this country. We've got 700 broker-dealers. We've probably got 3,000 asset managers. There are very, very different stories. So clearly, there are institutions that could access the capital markets, raised debt and equity, and have got themselves in strong financial shape to deal with the economic situation we're dealing with. On the other hand, there are a number of institutions that haven't. either haven't been able to access the market or their business models are truly going to struggle in this economic environment. So you have to talk about individual firms, not the industry.
Let's do that then. Will Morgan Stanley continue to issue FDIC guaranteed debt?
Morgan Stanley would do what it needs to do to prosper in its business, and we constantly look at the structure of our balance sheet, and we'll be issuing debt where and how we feel we need it. Morgan Stanley is now a bank holding company, so it has access to the discount window. A lot has changed becoming a bank holding company, both in terms of regulator and in terms of access to the discount window.
That is true, but I don't need to remind you that yesterday, Jamie Dimon, or I don't think it was Jamie Dimon, in fact, I think it was another official from JP Morgan, said they would not continue to issue FDIC guaranteed debt. So obviously this does create some competitive tension, and I think we'd like to know a bit more about Morgan Stanley's viewpoint on whether you think it's necessary given the spreads at which your debt is trading.
Listen, all I can say is that as of yesterday, we still did not have the authority to repay TARP. As of today, we do, and we're in discussions with the Treasury about the warrants, obviously, and we'll consider what debt we need to raise when we need to raise it.
All right, let us talk about a related matter, which is executive compensation. Getting rid of TARP means you're free of the Dodd Amendment, but discussions, as you know, are underway right now about new executive compensation restrictions. The president is going to propose this notion of a pay czar, a special master requiring independent pay panels, SEC power to require votes on executive pay, shareholders getting that say on pay. How will these rules affect Morgan Stanley?
Well, I think as our CEO, John Mack, has said repeatedly and in front of Congress, clearly the compensation structure across much of financial services got out of whack over the last several years. Morgan Stanley reacted to that, and our obligation is to our shareholders, our employees and our clients, irrespective of what other broader industry measures may be put in place. So we instituted a clawback program to ensure that individuals who made bad bets would live with the results of that bet over time. We pay all of our employees in a heavy amount of their compensation is in equity of the firm, and that equity vests over multiple years. So many of the initiatives you're hearing talked about are things we've actually put in place. And our CEO, as you know, was not compensated for the last 2 years, and several other executives for the last year.
Okay, well, you are, to a degree in that camp, you're among those whose salaries was raised. Other people at Morgan Stanley getting more salary in lieu of a bonus because of the restrictions in place under TARP. Now that you're free of TARP, will you keep those salaries higher as a result of the moves that were made recently?
Well, put it in perspective, salaries are still a relatively small percentage of total compensation. But the reality is that employees they have cash flow needs, they have basic family needs and expenses that they've got to live by. And we felt it was appropriate to make an adjustment which was from, by industry standards, artificially low salaries to make it more balanced between the salary and bonus.
Okay, but now that you're free of TARP, will bonuses be lower?
Well, bonuses will be based upon the performance of the business, and bonuses will have, as I said, the equity component, the clawback component, and will operate under what everybody would consider appropriate and reasonable compensation.
Well, but James, I mean, allow me for a moment to say that appropriate and reasonable is exactly the same terms that your firm would have used 2 years ago. So what's appropriate and reasonable today?
Well, I don't know that a lot has changed at Morgan Stanley over the last 2 years. We've become a Fed holding company for sure, but we've always paid our employees based upon the competitive pressures in the marketplace and the job that they're doing. What we've changed now is the mix of compensation from bonus to more salary and the clawback of those compensation payments.
So under a competitive scenario, is it possible, with about 20 seconds before we have to go to break, for a Morgan Stanley employee to make the same bonus in good times going forward that he did in good times in the past?
I would expect the overall bonus levels to be lower.
All right, there we go. We did get an answer finally. James, just sit tight. We'll be back. We're taking a short break, folks, talking with James Gorman, co-president of Morgan Stanley. Stay tuned. Welcome back, and we are with James Gorman, co-president of Morgan Stanley, continuing our discussion. James, we've covered a lot of ground. Now let us talk about a deal that you had a very, very key role in. This was merging Morgan Stanley's Global Wealth Management division with Smith Barney, the brokerage division of Citigroup. This deal closed last Monday. You've got 18,500 brokers now in this joint venture, $14 billion in pro forma net revenues. Answer me this, though. The stock market is in the phase of an incipient recovery, people might say, and there are still some doubts as to whether these gains are sustainable. Why does a merger like this make sense in today's environment, looking at the markets, looking at the economy?
For exactly that reason. There are enormous scale advantages in this business. This is the perfect time to be doing a transaction where you're consolidating organizations and taking advantage of scale. And secondly, frankly, more fundamentally, we don't determine corporate strategy based upon any 13 or 26-week period. Some people said to me, the market's down, would you rethink the deal? I said exactly the opposite. This is the environment, as I said, when consolidation should take place.
Okay, when you were at Merrill Lynch, and to remind everybody, you were at Merrill Lynch before you went to Morgan Stanley, you set the pace for the brokerage business, you reorganized that business, and you got it to a point where it was generating pre-tax margins of 20%, quarter in, quarter out, $800,000 of revenue per financial advisor. Can Morgan Stanley Smith Barney achieve numbers like that?
Well, for a start, Morgan Stanley's performance in the last 2 years has been producing at #1 in terms of revenue per advisor on the street. And our pre-tax margins went from effectively 1 to 3% to 17%. So in combination with Smith Barney, which had margins above 20% over the last several years, this will be a powerhouse. And as our CFO has called it, a game changer. So absolutely.
Okay, now, you can reproduce the kinds of numbers that you had at Merrill Lynch.
Absolutely.
What, though, will it take to get there? Will it require job cuts? If so, how many? Will it require operating cost reductions?
Well, there are a lot of efficiencies, obviously, bringing these platforms together because we run our operating platform, a different platform from Smith Barney. You combine those. We run 2 marketing and advertising organizations. You combine those. There are a lot of efficiencies. But as importantly, there are a lot of services and products that our clients can now access that were being offered by the other firm, in Smith Barney's case or in Morgan Stanley's case. So we're bringing together the best of breed in terms of products and services that will both help our clients. We believe long-term it's going to help the revenues of the business, and it will be run on a more efficient platform.
Okay, James, we're going to have to take another short break, but James Gorman, co-president of Morgan Stanley, is with us until the end of the hour, so do not go away. We will be continuing our conversation with him. We were just talking about Smith Barney, that firm merging with Morgan Stanley's Global Wealth Management Division. We'll have a question or two more on that, plus we'll be talking about strategy when we come back. Now continue with James Gorman, Morgan Stanley's co-president. James, Andy was just talking about the Treasury market. Given all the volatility there, it's been a great time for traders. Morgan Stanley was among the firms to scale back risk-taking over the past, say, year. I couldn't precisely define exactly when it began. And partly as a result, we saw a divergence in trading revenues over the course of the first quarter. A number of firms, Goldman, J.P. Morgan, generating huge revenue in trading. Morgan Stanley, not so much. In retrospect, was it a mistake to scale back risk-taking as much as you did?
No, I don't think it was. I mean, we shrank our balance sheet from $1.2 trillion to $650 billion. We brought our leverage down from in the mid-30s to the low teens. And I think we were prudent. Our CFO, Colm Kelleher, has consistently said through that period it was more important for us to stay close to shore. Now, any 13-week period, frankly, is not that important. What's important is the long-term strength and durability of the franchise. Eric, if the results have been different, if those firms had had a terrible first quarter, we would be applauded for staying close to the shore.
No question, but analysts are saying that the second quarter trading environment may be as good as the first, which is to say you could see similar numbers from some firms. So maybe it wasn't such a one-quarter phenomenon. Are you inclined to take your risk up, and have you been doing it?
Well, I think we've been adjusting our balance sheet through this whole cycle, and we'll continue doing that. I'm not going to obviously project the second quarter. We're very comfortable in our own skin.
What does it say, and is it possible for the top 5 firms left in this industry to generate $30 billion in trading revenue quarter in and quarter out, given everything that we've seen?
Well, listen, you've had a tremendous consolidation within the industry. You've had a widening of spreads, and you've had ultimately the same demand for capital markets activity and trading activity around the world. So those 3 things combined leave you with a scenario where the major firms on the street, of which Morgan Stanley is obviously in the top group, clearly can expect to have a robust environment going forward.
But do you think, can we look ahead and say that Morgan Stanley's trading results will improve from where they were in the first quarter?
Eric, I'm not going to project the second quarter for you. I'm sorry.
No,
that's
not the second quarter, just over time.
I fully expect us to be competitive on the street and have a robust trading business going forward.
How about the state of credit markets? We've obviously seen quite a bit of recovery in the corporate debt market. Sure. Asset-backed remains quite moribund, and we've seen a reversal in the progress that we saw in mortgages. What's needed to get credit markets back to a fully healthy state?
Well, it's liquidity, it's stability in the marketplace, and it's the continued success of the various government initiatives, all of which I think you're seeing. I mean, you're seeing assets clear off balance sheets at somewhere better than truly distressed prices. You're seeing bids that weren't in the marketplace as recently as 3 or 4 weeks ago. So you're starting to see the market clearing in a way that you would expect. Buyers are coming back into the market, seeing those opportunities.
All right. I'm afraid we do have to end it there. Some great insights into Morgan Stanley and the markets from James Gorman, the firm's co-president. Thank you so very much for joining us.
Thank you, Eric. Thanks for having me.